Here's a number that might surprise you. On some estimates, perpetual futures now account for the overwhelming majority of all crypto derivatives trading volume worldwide, dwarfing spot trading and traditional futures combined. Yet in the United States, this instrument has spent years stuck in regulatory limbo. Today, Tuesday the 28th of July 2026, that tension is back in the headlines. Don Wilson, the founder and chief executive of Chicago trading powerhouse DRW, has told CoinDesk in a new interview that regulators are getting crypto's biggest trading innovation all wrong. Wilson isn't a crypto newcomer chasing headlines. He built DRW into one of the most respected proprietary trading firms on Wall Street, and its crypto arm, Cumberland, has been market-making digital assets since 2014. When someone with that pedigree says the rulebook is misreading the market, it's worth understanding exactly what he means, and why it matters for anyone trading, building, or investing in crypto right now. Before we get into Wilson's argument, it helps to understand the product itself. Perpetual futures, or Perps, are derivative contracts that let traders bet on the price of an asset like Bitcoin or Ethereum without ever taking delivery of it, and crucially, without an expiry date. Traditional futures contracts settle on a fixed date, forcing traders to roll their positions over repeatedly, which adds cost and complexity. Perps solve that by using something called a funding rate, a periodic payment exchanged between traders who are long and traders who are short, designed to keep the contract's price tethered closely to the actual spot price of the underlying asset. This instrument was pioneered on the crypto exchange BitMEX around 2016 and was later scaled aggressively by platforms like Binance and Bybit. It became the default way most of the world trades crypto with leverage, precisely because it never needs to close out and reopen. According to Wilson, the sticking point for regulators has been the funding rate mechanism itself, which some officials have treated with suspicion, as if it were an exotic or unstable feature. His counter-argument is that the funding rate actually does the opposite of what critics fear. Rather than introducing hidden risk, it continuously realigns the contract price with the spot market, which limits the kind of large basis distortions that can build up in traditional dated futures as they approach expiry. In his view, U.S. regulators have effectively penalized innovation by treating a self-correcting pricing tool as a red flag, when in practice it is closer to a safety valve. This is a familiar pattern in financial regulation, where a genuinely new market structure takes years to be understood by policymakers who cut their teeth on older instruments like standard futures and options. This isn't a debate happening in a vacuum. Over the past year, the regulatory picture around crypto derivatives in the United States has been shifting. The Commodity Futures Trading Commission has been engaging more directly with exchanges seeking to list regulated perpetual-style products domestically, and platforms including Coinbase have pushed to bring Cftc-overseen perpetual futures to American users, aiming to compete with the offshore giants that have dominated this corner of the market for nearly a decade. Wilson's comments today land right in the middle of that shift, effectively arguing that the industry has already proven this product works safely at enormous scale overseas, and that U.S. policy should catch up rather than continue treating Perps as a problem to be contained. His remarks add weight from a firm that has operated on both sides, as a traditional derivatives trader on Wall Street and as a major liquidity provider in crypto markets. The practical consequence of years of regulatory caution has been straightforward. Because perpetual futures have been largely unavailable through fully regulated U.S. venues, traders, including plenty of American ones, have routed enormous volumes through offshore exchanges instead. That has meant less oversight, less consumer protection, and less tax and reporting clarity than a domestically regulated product could offer. For institutional players like DRW and Cumberland, this creates a genuine business problem, because they must navigate a fragmented landscape of onshore and offshore venues just to access the deepest pools of liquidity. For everyday traders, it has often meant using platforms outside the direct reach of U.S. regulators to access the instrument that dominates global crypto trading. Wilson's argument is essentially that this fragmentation is a direct result of the regulatory misunderstanding he is describing, not an unavoidable feature of the market. So what happens from here? The direction of travel suggests gradual movement toward more regulated crypto perpetual products becoming available domestically, as exchanges continue working with the CFTC on approved listings. If that trend continues through the rest of 2026, expect more US-based venues to roll out their own versions of perpetual-style contracts, likely with adjusted leverage limits and reporting requirements compared to their offshore counterparts. Industry voices like Wilson's are likely to keep pushing publicly for regulators to treat the funding rate mechanism as a known, well-tested tool rather than a novelty, especially given nearly a decade of trading history from exchanges outside the US. Whether policymakers move quickly or slowly will likely depend on broader political appetite for crypto market structure reform, which has been a live topic in Washington throughout this year. The core message from Don Wilson is this: perpetual futures aren't some fringe, high-risk gimmick, they're the instrument that already runs the majority of global crypto trading, built on a funding mechanism specifically designed to keep prices honest. The real risk, in his view, is not the product itself but a regulatory framework that hasn't caught up with how the market already works. For traders and investors watching this space, the lesson is to keep an eye on CFTC approvals over the coming months, because each new regulated listing narrows the gap between where global crypto liquidity actually sits and where US law currently allows it to be traded. Whether or not regulators fully embrace Wilson's framing, the pressure to modernize is clearly building, and today's comments are another sign that Wall Street veterans and crypto natives are increasingly making the same argument from opposite ends of the market.